You're listening to the Millionacres Podcast. Our mission at Millionacres is to educate and empower investors to make great decisions and achieve real estate investing success. We provide regular content and perspective for everyone, from those just starting out to seasoned pros with decades of experience. At Millionacres, we work every day to help you demystify real estate investing,
Hello, I'm Deidre Woolard, an editor at Millionacres, and thank you so much for tuning into the Millionacres Podcast. Today we are talking about taxes, and more specifically, how you can set up your tax structures when it comes to your real estate investing business. With the caveat that none of what you hear today constitutes individual tax advice, let's dive in with Steve Moskowitz. Steve has over 30 years of experience as a tax attorney. His mission is to help smaller businesses and individuals deal with complicated tax issues, and there are plenty of those. Welcome, Steve.
Thanks so much for inviting me. I always have a good time talking about taxes. And, people think I'm joking when I say that, but I mean it because I get a visceral thrill out of legally saving taxes for people. And look at the big boys. Look at all the wealthy people in Fortune 500 that make billions with a B and they don't pay taxes. And people point their fingers and say, whoa, that's not fair. How come that big boy is not paying any taxes and making all that money? That's called tax planning. Now, why should there be something like this? There's two purposes to the tax law. Everybody knows about one purpose. That's to extract money from us. But the other purpose is that in a democracy, the government can't order us to do something. It can't say, I order you to buy a rental building. I order you to buy a factory. So how does the government get us to do something they want us to do, but they can't order us? They give us tax incentives. That's the other part of the law. Wealthy people know that. The big corporations know that. Most smaller businesses, individuals, just grumble and pay, and you don't have to. But what happens is, think of it like this. Suppose I said, I'm going to put my business card on your desk, and you just take this over to the IRS, and I'll write you a check for $1 million. Would you do it?
Well, yeah.
I would hope so. Well, let's just say that was legal. Okay, so sure you'd do it. But suppose I put my business card in a dump truck with 1 million other business cards. I mixed them up with a big shovel, and then I backed the dump truck into your office, and I dumped 1 million business cards into your office. What would you do? You'd probably say, oh, what a mess. I'll have to pay somebody to clear this mess out. Not realizing that you had the $1 million business card in there. That's what our tax law is. These things are available to everybody, but like those 1 million business cards, you don't see it because of the forest. That's why somebody like me goes in and says, well, wait a minute, for you, we can do this, this, and this. That's what classic tax planning is. And that's what we'd like to tell your listeners about. There's so much the real estate investor can do to legally save taxes, just like the big boys.
I think that's really great because I think people don't even want to get started in real estate investing because of the complications. I've had people tell me, well, I don't want to invest in other states because of K-1s, or I don't want to invest in rental property because I don't know how to calculate depreciation and I don't want to have to deal with that.
I don't know how to change the oil in my car. That doesn't mean I don't drive. I have somebody change it for me. And real estate, above all else, is where the majority of wealth is concentrated. So if you want to make the biggest bucks, you do it in real estate. And the tax laws have so many favorable areas for real estate. It is a crying shame, just like throwing away my $1 million business card.
So if you're an individual investor, do you have to set up an LLC or an S Corp? I think that is one of the hurdles that people sort of get stuck on first is, can I just invest as an individual and will that impact my taxes in a negative way?
Excellent question. Do you have to set up an entity? No. Should you? Absolutely, positively, yes. And let's talk about why. Number one, asset protection. Suppose you're a landlord and you have a tenant, and your tenant gets rip-roaring drunk, falls down, and becomes a quadriplegic. You know that tenant's going to sue you. And if the jury says, okay, well, you're a quadriplegic, we're going to award you an amount of money in excess of the insurance, you could lose everything you have. One lawsuit can wipe out an entire lifetime of earning and saving. And you don't want to be like that. That's why you want to set up an entity. And by setting up an entity, You protect yourself. So in my example, that same lawsuit, the max the plaintiff could take would be the equity of that one entity. Everything else is safe. Your other entities, your personal assets, everything's safe. That's the first reason. The second reason is we go back to the Tax Cuts and Jobs Act, which gave us a lot of good things, but also it took away some things too. For those people that are listening in states that have a state income tax, you lost the ability to deduct your state tax in excess of $10,000 on your federal return. Almost half of the states have enacted workarounds, which essentially work like this. You form an entity, you make an election to pay the state taxes at the entity level, which is still tax deductible under the Tax Cuts and Jobs Act. The state gives you a credit, so when the smoke clears, you don't pay 1 penny more in state taxes, but now you get to deduct an unlimited amount of state taxes on your federal return. So the bottom line is, no, you don't have to form an entity, but you want to for asset protection and tax advantages. And when somebody gives you something nice, what do you say?
You say thank you.
If you're a lawyer, you say, more, I want more, give me more. And that's what I have for you. I have more. One of the things we want to do is talk about a retirement account. Now, people are familiar with the simple ones like 401k, IRAs, things like that. But they're not familiar with the fancier ones. There's over 20 different types of retirement accounts. And what happens with the retirement accounts, you say, okay, well, what we want to do is the retirement accounts are set up to offset business income, not investment income. So we set up an entity. Still another reason, we're still talking about one entity, and now we're on our third good reason to do it. We set up the entity, we do all the transactions through the entity, and then we can go ahead and offset our real estate income through our pension distribution. So basically, you're faced with this tough question. Would you prefer to A, pay less taxes and put your money away in a special place where it's safe from everybody, or B, pay more taxes, let your money sit in the bank where a plaintiff can easily seize it? There's multiple benefits to a pension. First, you get a tax deduction. Most people say, hey, I'm in. But beyond the pension, the earnings of a retirement account are not taxed while it's sitting in there. Obviously, no brainer, your fund is going to grow a lot more and be a lot bigger if you're not taxed than if you are. Next, pensions, retirement accounts enjoy a special place in federal law. They have all these protections. So if somebody sues you, even if they win, they can't touch your pension. And although I hate to mention his name, O.J. Simpson is the poster boy for this. O.J. has a multi-million-dollar judgment against him for many years. He's not lost 1 penny of his pension. And if something horrible happens to you and you have to go bankrupt, you still keep 100% of your pension. And if that's not enough for you, you have additional cash flow benefits. So what happens is, suppose we have this situation. In almost all cases, when you set up tax planning for almost everything, you have to write the check by December 31st, year one, in order to deduct it in year one. But not with most of the pensions. With most of the pensions, you get up to the time of filing the return plus extension. So suppose, for example, you say, I'm going to form an S Corp. And you go ahead and you do that. And then you can make a contribution payment as late as September 15th, year two, and still deduct it off your taxes from year one. You want more? I have more for you. Well, I warned you. I warned you up front. I get excited when I talk about taxes. You were warned. You were warned. So what happens is these pensions have such flexibility. Suppose you, and this can happen in real estate, you make a big sale, and in this year you've made beaucoup. You say, this is wonderful. Based on my astute investing, I have made beaucoup. But I don't want to pay beaucoup in taxes. What could I do? Now, the pensions that I'm talking about, they're not real limited like the 401ks where here's the ceiling and that's that. To give you an idea, our average clients deduct hundreds of thousands of dollars for themselves each year. We have some clients that deduct seven figures. So yeah, they're really big. So what happens is, but now we've made this sale and we have an unusually big profit. That's a good thing. With some of these fancy pensions, we can make multiple pension year contributions in one calendar year. So basically what happens in that year where you made beaucoup, essentially you take multiple pension years, you make the contribution in that year so that when the smoke clears, you have multiple years in there, a giant pension contribution. Not to mention there's other types of provisions where you can have multiple years, giant deduction to offset this giant amount because we don't want to pay taxes and we don't have, I've dedicated my career to that. That's why I became a tax attorney because when I set foot into law school, I already had a bachelor's and master's degree in accounting. I was already a practicing CPA, but I wanted to do more for my clients and I wanted to be able to go ahead and defend it. That's why I went to law school. I didn't want to chase ambulances. I didn't want to do divorces. I wanted to do tax. So I'm doing what I want to do. And the heart and soul of this, and when to me tax, it's not just people when they think about taxes, they think about the tax forms. Okay, I have this pile of papers, and I'm going to move the number from this piece of paper to the tax form. I'm going to move this number, I'm going to add it up and subtract and multiply. Yeah, we do that too. But basically, the tax return should merely be a summarization of a year of tax planning. The big boys don't concern themselves with, so how did you fill those forms out right? The big boys say, hey, I don't want to pay taxes. What do I have to do to legally achieve that? That's what this is all about. And with real estate, this goes on and on and on. Another example is time value of money. That's how banks make money. If I said to you, I'm going to give you a choice of having a benefit today or 39 years from today, which would you choose?
Well, I think it would depend on what the benefit was and if it accrued value over time.
Same benefit. I'm going to give you $1 and you can have the dollar today or 39 years from today.
Then I'd rather have it today.
Exactly. Then you understand cost segregation analysis. So what happens is when you have real property, you have depreciation. So you have to depreciate that property over a long period of time. 39 years on commercial property, 27 and a half on residential. So what cost segregation analysis is, we go ahead and send an engineer to the building, and he or she says, well, this part is 39 or 27 and a half year property, but this part's 15-year property, this part is 10-year property, this part's 5-year property, and this part you can write off this year. So we have a much, much bigger deduction. So we can have the sweetest thing in life, most beautiful words in the English language. I'm going to share them with you now. A positive cash flow with a tax loss. You say, this is wonderful. I have a building and I brought in a lot more cash than I've spent on expenses, so I have a cash profit. Now, I don't write a check to depreciation. It's just a paper entry. Somebody makes an entry someplace in a computer. And I say, okay, even though I have this cash profit, I've brought my profit down to zero. That's wonderful. But again, now you know the correct answer. When somebody gives you something nice, what do you say?
You say more.
Exactly. Good. You've learned. Everybody learned. So what happens, then you say the question, well, I still have some loss left over with my depreciation. Could I use that excess loss against other income, like profits from a business, wages, dividends, interest? And the general rule is no. Internal Revenue Code Section 469, the passive activity loss rule says, well, it's a passive activity. You can't do that. But there's an exception to that, the real estate professional rules. And essentially what happens is if you're married, only one spouse has to qualify and will cover both spouses on a joint return. Essentially what happens is you are spending more time in the real estate activity than you are in the other activity. That's what keeps most people out of this because they, well, I work 2,000 hours as a doctor, so I'd have to work 2,001 hours as a real estate professional. But suppose our doctor is married to a house husband and he's sitting on the sofa watching Oprah and she comes home to him and says, honey, you're now in charge of our real property investments. And he doesn't have to do much to become a real estate professional. Now what happens, it converts what would have otherwise been a passive activity loss, which the good doctor couldn't take if she was single, into a tax deduction. Now she can use that for offsetting profits on her business or other investments or anything else. So again, what you want to do is these things don't stand alone. You want to parlay them. And there's just so very, very, very much we can do with real estate. We start parlaying things and parlaying. And so my example here with the brain surgeon married to the house husband, not only did she go ahead and wipe out the profit on her rental building, now she's gone ahead and used that depreciation to wipe out profit on her medical practice. So she has a situation where she's got a whole bunch of cash and she's legally not paying any income taxes on it because of these rules. And again, they're all there for any of us. It's just ask and ye shall receive. But you have to know where they are. That's that hidden business card. And I can go on and on and on and on, but you get the idea. And maybe you want to get in a word edgewise. Who knows?
Well, one question I have related to what you just said is, how do you prove that you're the real estate professional? Like, you don't have to be an agent to qualify for this, right?
So basically, good record keeping. And what we do with our clients, we give them a little chart and say, here, make sure you do these things. And basically what you're doing is you're saying, okay, I'm inspecting the building, I'm collecting the rents. If somebody has a complaint or an idea, I think the building should have a heated swimming pool. Okay, well, let me take that under advisement and study it. Another thing you would do is you're checking out the local neighborhoods. Are there other properties around? What are they offering their tenants? Is there a building down the street that's newer and they're charging less rent? What do I have to do to keep my tenants in my building? And what happens is, we actually literally physically provide the client with a list. Here, do this stuff, keep track of your time, and it's very generous. The Congress in the real estate area has given us so many benefits. For example, and President Biden is looking at some of these, and we have to watch out to make sure that they're not taken away. Hopefully they won't be. For example, we talk about like a step up in basis. So you don't have that with so many other areas, but here you have so many opportunities in real estate that don't exist other places. For example, we talk about capital gains, where if I go ahead and I make a certain amount in wages, I get taxed on that. If I have a real estate investor who's my next door neighbor and makes the exact amount of money that I made from my wages by selling his real estate, he or she pays a lesser tax because they're paying a lower capital gains rate. President Biden has his eye on that right now, and he wants to take that away. But I think that a lot of Congress people are going to say, well, even though they're giving away trillions in different programs, if you take that away, you're going to have a lot of angry constituents, and we know what angry constituents do when they go into the voting booth. That's one of the things we want to take a look at. Same with the step up in basis. Another thing with step up in basis is so valuable. Suppose Grandpa bought a building for $10,000 when he was a young man. And when Grandpa goes to his reward, that very same building is worth $1 million. And he's given that building to his grandson through his estate. Grandson gets what's called a step up in basis, which is fair market value at date of death or alternative valuation date. Let's not worry about that. Let's keep it simple. So I told you the building's worth $1 million now. Originally only cost Grandpa 10. So grandson sells the building the next day. Sales price $1 million, minus stepped up basis $1 million, tax profit 0, tax 0. President Biden also has his eye on that one. Another one President Biden has his eye on is the 1031s. So what happens with 1031s? So a 1031 is, suppose I have building A, and I say, I'd really like to get out of building A and get into building B. I could sell building A and buy building B, but if I sell building A, I'm going to get hit with a tax. Now, it's a lesser tax, it's a capital gains tax, but I don't want to pay any tax, even a lesser tax. So I could do an exchange. I could basically trade building A for building B. And then in the Tax Cuts and Jobs Act, that was narrowed to only real estate, because before that you could do that with other property too. But there's a backdoor way doing the other property. So for example, suppose that I have a hotel or apartment building, and I have a lot of personality in the building. Then what happens is, can't do the 1031 on that anymore. But through the use of bonus depreciation, I can do a separate contract and wind up writing off the whole thing, so not be taxed on that. So that's good. And another thing too, the technical corrections cleared up some problems where how long do I have to depreciate the improvements in the property? There was a 15-year life, but with bonus depreciation, we can write the whole thing off. Mumbo jumbo, I'm starting to get too complicated now. The bottom line is, because I felt some people's eyes starting to roll around. The bottom line is there's all this special stuff in real estate, so you don't pay taxes. But I'm gonna go back to 1031s for a minute. So what a lot of people do is they just exchange properties so they don't pay any taxes. Now, President Biden has his eye on that, and he's proposing, saying, well, you know what, let's limit this to, just a $500,000 for singles, $1 for married people. But again, the Congress, they have to watch. They're going to have mad constituents if you do that. So there's another thing that a lot of people miss with 1031s, and this is real important. And people should all know about DST, Delaware Statutory Trust. Now, number one, don't worry, you don't have to live in Delaware to do this.
Right.
This is an investment device that you can purchase anywhere in the country from the financial institution of your choice. So let me tell you the multiple benefits of this. First, as a practicing tax attorney, I can't tell you how many people over the years have walked into my office, waving a piece of paper at me, saying, but it was a done deal. It was a done deal. As you know, there's a very short identification period with the properties. So I say, well, you know what, I'm sure it's a done deal. I'm going to go ahead and dispose of property A, and I'm getting property B here, no problem. And guess what? Property B falls through. And now they get stuck with a tax. So one of the things that I always recommend is name as one of the properties a DST. So if that absolutely 100% is going to happen, done deal, falls through, and a lot of times they do, you just go ahead, you have the DST, because the Delaware Statutory Trust qualifies as 1031 property. So I know a listener saying, Steve, what is a DST? Tell me. So what a DST is, essentially, it's like a mutual fund for real properties. And this works out beautifully when people want to stop being a landlord. Because I had a lot of clients that say to me, Steve, I'm tired of being a landlord. I don't want to deal with somebody's sink problems or anything else. And I'd like to go sit on the beach, but I don't want to pay the taxes. So I say, okay, let's do a DST. So now essentially, instead of holding a building, you're holding a mutual fund in real properties. But it qualifies for 1031. And then the beauty is, think of people that want to retire. If you want to retire and you say, look, it's time I want to sit on the beach now and I'm done working, okay. But if you cash out and you sell the property, you get taxed. And what happens is, so suppose you had a big building, and I have some clients that basically their building is their life, their retirement, their earnings, their everything. So they sell the building. You could do an installment sale, but then you have to worry that the people are going to pay you or not. He said, well, I don't want to worry about that. I just want to sit on the beach. I don't want to worry somebody's not going to pay me. So you say, okay, you sell the building, get a big tax, and that money is going to last the rest of your lifetime. But there's a lot less of it because of the tax. The beauty of the DST is you only have to sell the shares that you need. You can sell these shares over the rest of your lifetime, spread that tax over your lifetime. And the beauty is when you're not paying taxes, those DSTs are still earning for you. So there's so much you can do in the real estate area. And by no means, no shape or form, am I saying, when we're finished with our podcast today, that's all you need to know, and I've covered every possible angle in real estate, goodbye and thank you. I'm throwing out some teasers because there's so much here. Basically what I would say is, you really want to sit down with somebody. This is like a physician who says, you know what, modern medicine does a lot of things for people and deals with a lot of medical conditions. But the doctor can't say, okay, I'm going to give you a list of all conditions and the cures, because he or she would never stop talking. That's true with real estate. There's so very much here. And people should be aware of it.
All right, let's take a quick break there.
Like what you're hearing? Get more real estate investing news and advice from Millionacres on Instagram at Millionacres and on Twitter at Millionacres_co.
Some of our listeners are undoubtedly among the fortunate group sitting on piles of valuable tech stock. If you're one of them, listen up. Urban Catalyst could help you with your tax bill when it comes time to sell. Urban Catalyst is the premier qualified opportunity zone fund based in Silicon Valley. And if you meet investors' qualifications and invest in a qualified opportunity zone fund, you could potentially get big tax breaks. Here's how it works. When you go to sell your stock, you will likely generate a large capital gains tax bill, which means Uncle Sam may want to take a large chunk of it. If you're not keen on sending all that money to the U.S. Treasury, Opportunity Zone funds like Urban Catalyst can help you shield those gains. And Urban Catalyst isn't just any Opportunity Zone fund. Forbes magazine and the Sorensen Impact Center ranked Urban Catalyst one of the top 20 OZ funds in the country. Don't wait too long. If you invest before the end of this year, you may not only defer capital gains taxes, but you also may be able to reduce your capital gains by 10%. And as an added incentive, if you hold your investment for 10 years, you will likely not have to pay any federal taxes at all on those gains. And it's not just stock sales. Capital gains from real estate sales, selling your business, or even a big crypto sale, these types of capital gains can all get potentially favorable tax treatment by investing in an Opportunity Zone fund. Urban Catalyst focuses on development in downtown San Jose, an area prime for growth and revitalization. You can learn more about the fund and the numerous development projects underway by visiting urbancatalyst.com/millionacres. But keep an eye on your calendar. You only have 180 days after your capital gains event to invest in an Opportunity Zone program. So visit urbancatalyst.com/millionacres today.
I'm back with Steve Moskowitz. We're talking all things real estate taxes, which is his favorite subject, which is awesome. So in this segment, we're going to talk about some of the topics that are kind of top of mind right now. Let's start with the Pandora Papers, because that has been in the news for the last few days. There's a lot of talk about how people use real estate to hide money, to launder money. As a tax attorney, what's your take on all of this?
People wanting to beat the tax system is as old as the tax systems. Thousands of years ago in China, there was a complex tax system, and people went ahead and they worked on systems to try to beat it. And a lot of, in real estate today, a lot of times you do a transaction, you have these funny terms when you do a transaction in real estate, these extra funny words that go along with it. You know where these funny words came from? They came from my medieval counterparts, because what happened was the big taxes were on land at that time. So what would happen is you would basically have the medieval version of a tax return and say, well, if you transfer it as X, you're taxed. Why don't we transfer it as X plus A? Oh, and then it's just like fencing. Thrust, counter thrust. So then the government says, well, okay, well, X plus A is taxable. Oh, all right. How about X plus A plus B? And that's why to these very days, sometimes when you do transactions, clients say, what are all these funny words here? And basically they're kind of some of the remnants of that. So this has always existed. And what happens is, people act in great shock when, like with these papers here, there were some very well-known people that are being put in the spotlight who really shouldn't have done that. But this is human nature. You can see that people at all levels sometimes break the law. And what happens is there's always somebody that thinks they're smarter than somebody else, but there's always somebody else comes along that's smarter still, and they get caught. So what happens is, it's like, obviously, as a tax attorney, I would never counsel anybody to do anything illegal. We'll defend them if they're accused of doing something illegal. But a major part in taxes, where the bad part of what some people do in tax, is where people go over to what we'll call it the dark side, the Darth Vader side, where they decide instead of doing something fancy to legally avoid the taxes, They just hide it. This is a variation of a merchant who basically somebody walks into his store and he puts every other dollar in his pocket or every 10th dollar, or another thing that a lot of business people were doing. And this was especially true before the IRS cracked down on the foreign bank accounts. Suppose you had a business person in the United States who was going to make a sale to some company. And the company said, okay, fine, we'll mail you a check. And the business person wanted to cheat on his taxes. Said, oh, no. Don't write me a check. Wire the money to their bank account and name the country, Switzerland, Hong Kong, wherever. So what happens with properties, the government has been cracking down for years now on these properties. And what they're looking for is sometimes when people want to, and again, I'm not advocating to do anything illegal. I'm advocating comply with all laws. But I'm answering the question of, well, what did some people do that was like robbing a bank? Well, I wouldn't recommend robbing a bank, but if you ask me the question, well, sometimes somebody comes in with a gun or somebody does embezzlement. So what people were doing is they'd set up these shell companies. So John Smith wants to cheat on his taxes, but he doesn't want to put the property in his name. So what happens is he sets up some type of shell company, the XYZ company. Then the XYZ company comes in and purchases the building for cash. So now if the IRS looks at John Smith, well, he doesn't have anything, but it exists someplace. And one of the things the government's been looking at is they actually went ahead and started with certain areas, like in Manhattan and certain places in California and some other places that have some really nice buildings. Who owns these properties? So if you own it in your own name, whether you have a mortgage or not, fine. But they're looking at these shell companies that just waltz in with a lot of cash and say, yeah, I'll buy that building on Park Avenue, or I'll buy that building on Rodeo Drive. That's just one of the things they're looking at. And the papers you're talking about, very recently, some more people were exposed that, to some people it was shocking. This is nothing new. This has been going on since tax systems were around thousands of years ago in China, in the Middle Ages in Europe, and today. I mean, there are some people that cheat on their taxes, and most people don't. Actually, most people cheat themselves by not taking everything to which they're legally titled. But there's a few people, it's like everything else. There's a few rotten apples that spoil the bunch. It's kind of like, why do I have to take my shoes off when I take an airplane? I'm not going to do anything harmful on that airplane. But because some bad guy tried to set off a shoe bomb, now everybody has to take off their shoes because of him. And that's what happens with a lot of tax laws. You get a few rotten apples that really make it tougher on everybody else. So that's part of what you're talking about.
Interesting. So you mentioned earlier the Tax Cuts and Jobs Act. Let's also talk about Section 199A, which is the pass-through deduction.
One of my favorites.
I know. I looked at your website, so I know it's one of your favorites. People have heard of it as the pass-through deduction, but a lot of investors don't really understand what it means.
Special rules with real estate. So first of all, let's find out what 199A is all about. Suppose I'm going to ask you a tough tax question, and this is unrehearsed, so we're going to find out if the host really knows her stuff or not. Is everybody ready?
Uh-oh.
I'm going to give you a choice, A or B.
Oh, no.
If you made $1 million, would you prefer to A, pay tax on the million, or B, legally pay the tax on $800,000? You may use your calculator if you want.
I think I'm going with B.
Correct answer. And that's what 199A does for us. It's a pass-through, and I could make your eyes roll around with telling you the details. But for the most part, most taxpayers that would qualify for this, essentially, you only pay 80% of your profit instead of 100%. So you say, well, okay, this is a show about real estate. Does this work for real estate? Now we give you a lawyer's answer. It depends. If the real estate is an investment, no. If it's a business, yes. You say, well, wait a minute. Here I am. I'm John Smith, and I own some real estate. So which is it? I mean, I want to go ahead and pay tax on 80% instead of 100%. What do you have to do? Well, there's some things the government looks at. Suppose, for example, John Smith owns 1,000 real properties throughout the United States. He's in the real estate business. Suppose John owns one triple net lease. That looks an awful lot like an investment. Again, I'm not saying for sure, but I'm just giving you the extremes. So what we want to do is we want to set up a company, still another advantage of having a company, and we want to show how we are in the real estate business as opposed to making a real estate investment. And you say, well, what happens if I get audited? So first of all, people should stop fearing audits. Most of your listeners probably drive a vehicle. Do you realize if you drive a vehicle, you may come into a confrontation with organized law enforcement? A police officer may say, pull over, I want to see your driver's license and your insurance, registration, all that stuff. You could avoid that by never driving again, but I don't think most people would get that extreme. So I've always talked about, and I've talked about this on the radio for 30 years. I always called it multi-million-dollar bank book. You should take everything to which you're legally entitled, no more and no less. So what if you get audited? It's like tonight when I'm driving home, if a police officer wants to see my driver's license, that's fine. I haven't been drinking. Here's my driver's license. Here's my registration. Here's my insurance. A few minutes, he checks his computer, and I'm on my way. So that's what we have here. So most people don't get audited, but let's assume that John Smith gets audited here. Nothing to fear. What John should do is go ahead and be represented, because this is a specialty. I wouldn't say, you should do your own dentistry or prescribe your own eyeglasses. Our society since the 1700s, Adam Smith's specialization of labor, we all do what we like or do best and have somebody do everything else. So what happens is, if we agree with the auditor, that's wonderful. But suppose we don't. And suppose we've done some fancy stuff and the auditor says, what is all this stuff here? And the auditor disallows it. Oh no, what do we do now? Well, what the smart person would do is say, I disagree with you. And here's a big difference between the way an accountant handles an audit and the way a lawyer handles an audit. Suppose the auditor disagrees with what you've done, and that happens all the time, and he disallows something. So what the accountants do is they file for an appeal, and they go directly to an appeals officer. We wouldn't do that. What we would do is say to the auditor, okay, you're too tough for me, issue your report. And then we would ignore his letters, wait for the notice of deficiency, sometimes known as the 90-day letter, spend $60 of the client's money for the filing fee, file in tax court, and then the clerk of the tax court automatically sends the case back to that very same appeals officer the accountant went to directly. You say, well, wait a minute, Steve. Why did you take that circuitous path to wind up in the same place and spend $60 of the client's money to do that? Well, possible reason could you just, well, I have two reasons. One reason is once the case is docketed in tax court, the burden of proof shifts from the taxpayer to the government for any new issues raised by the government. So here's what happens. The appeals officer is much more experienced than the auditor. So let's assume on your return, the auditor is wrong in what he or she determined, but there's some other stuff on the return that was so fancy they didn't even understand it, and they didn't bring it up. The appeals officer is smarter, more knowledgeable, and says, well, wait a minute, now that you're here, I agree the auditor was wrong, but I want to talk about these other issues. Oh, we don't want that to happen. And the way we do it is we go ahead and we file in tax court, because now that appeals person would have to prove that the taxpayer was not entitled to it. And as a practical matter, the way the cases are set, by the time he gets the case, he wouldn't have enough time to even get the records through the processing system, so they don't bring it up. So that's one reason, but I promised you two. If you look at the statistics on a docketed case, that means the lawyer put it into tax court, the government gives you much better concessions. Why do they do that? Because when the accountant goes to the appeals officer, that's the accountant's final stop. He can't go anymore. When the lawyer goes to the appeals officer, the lawyer actually has to do something to stop the case from automatically going to the tax court. So, for example, if the lawyer filed it and then got run over by a truck and didn't show up for the hearing, the case would automatically be sent to the tax court. So they give you much better settlements. And let's talk about the tax court. For all 50 states, you know there's only 19 presidentially appointed judges? You say, well, wait a minute.
Really?
We have 50, yeah, really. We have 50 states, 19 judges. The math doesn't work. How does that work? They literally travel around the country, just like Abraham Lincoln. They're riding the circuit. And what happens is they really don't have the time to hear your case. They really don't. But you have the right to be there. So what happens? So you get another chance to settle with the IRS attorneys. And in fairness to the IRS attorneys, if you go into tax court, you always know who the government attorneys are and who the defense attorneys are. They're just like prosecutors. If you go into a criminal court, you always know who the prosecutors are, because the government attorneys walk in with this enormous stack of file folders in their arms because they got all these cases to do. They have too many cases. Defense attorneys don't have nearly as many cases as the prosecutors, so you can spend more time on your case. They don't have the time for the cases, and the way the system is set up, almost all cases settle. So again, you have the right to go into court, you have the right to talk to the judge, and what a lot of people don't realize is your word is worth something. So when you go back to that initial, now again, there's a big difference between defense and planning. For planning, I counsel that you keep every document for the rest of your life. You buy somebody a cup of coffee, keep the document for the rest of your life.
Not the 7 years that people usually throw out?
No, and I'll tell you why. Because what happens is, this happens in practice all the time. Suppose the government comes back to you 10 years later and says, you didn't file your tax return from 10 years ago because the statute of limitations doesn't begin to run until you file the return plus 3 years. You say, well, yes, I did. They said, prove it. Oh, I threw out all my records. Okay, you can't prove it? Here's your tax bill. So I always recommend keep it forever. I know it's a pain, but not as much of a pain as paying taxes. You don't have to. So the bottom line is you say, well, okay, what happens here? So they want to have they have an incentive to make a deal. Just like we talked about earlier, you have the right to take the judge's time and explain it. And a lot of times what happens, an auditor will say, if you don't have a piece of paper, it didn't happen. And I say, well, that's the preferable way. But if you don't have a birth certificate, that doesn't mean you were never born. And let me tell you about a case. We all remember the famous boxer, Joe Frazier. Joe Frazier took some tax deductions on his mother's farm in Beaufort, South Carolina. And the IRS didn't like his deductions, and they said, disallowed, Joe. And Joe went into tax court. Joe had one witness, his aged mother. And his mother testified for Joe. And the tax court judge that decided the case found for Joe. And you know what he wrote in his opinion? He looked at Joe's mother, he listened to Joe's mother, and he saw and he heard an honest woman, and he believed her. And people forget about those things. There's a lot of ways to prove things. It's called substitute evidence. There's lots and lots and lots of ways. Again, if you ask me for planning, of course, have the canceled check and the receipt and all that. But I'm talking about real life. And in real life, a lot of times people just don't do what they're supposed to. If they did what they were supposed to, there'd be no work for lawyers. So they haven't done what they're supposed to. But there's lots of other ways to prove it. And that's just one of the things here. So there's so many things. And I could take up your whole podcast and then some, just talking about on substitute evidence. What's an example of substitute evidence? Witnesses, say, for example, I saw this, or with real estate. With real estate, when you sell it, every improvement you've ever made, you should keep that receipt. That would be another example of don't throw your stuff away in 7 years. Maybe you're selling your house 40 years later. Well, I have 40 years worth of improvements I made. I put in a new kitchen, I put on a new roof, I put on this, I did that. You want to keep all those receipts. But what if you didn't? You can call your neighbor or your friend and say, yeah, I remember when Mr. Smith and Mrs. Smith, they were redoing the kitchen. We had to eat in card tables on the living room. I remember, I saw that go up. And then you can say, well, look, we proved that the kitchen was done in this year, and the average cost to do something like that is this. You can also bring in experts who say, well, look, I'm an expert on kitchen remodeling, and in the year of so-and-so, to do a remodel like this, it's about X number of dollars. Also, I always recommend take pictures. I've shown pictures where I was representing somebody and said, look, I don't have the documents, but I can show before and after pictures. So there's lots and lots and lots of ways to prove things. And don't be so confined because some auditor is saying, where is the receipt if you do not have the receipt? Disallowed, disallowed, disallowed. Okay, hey, whoa, come on. So there's lots and lots of ways to prove these things.
All right. Well, I want to get to a couple of things before we wrap up. And one of them is opportunity zones, because that's something we get tons of questions about. I believe that some of the step-up basis goes away this year. So
December 31st.
yeah. So what do we need to know about that?
Okay, so opportunity zones are a government creation where basically there's this long list of areas where the government says, if you invest here, we'll give you all kinds of special stuff. That goes back to how we opened the show with the government can't order me to buy some property in a certain neighborhood, but they can give me incentives. So basically what happens here is they say, all right, suppose you have a capital gain. And here we can do a lot of backdoor stuff because we say, all right, I have a capital gain. And within 180 days, if I go ahead and put the money into an opportunity zone, I can push off the taxes for a while on the original sale. Then with the opportunity zone itself, I can make beaucoup, and if I hold the property long enough, that's what you're talking about, is not have the capital gain on that. And then we can get really fancy because if you have a company that invests in the opportunity zone, you don't have to have 100% of the property in the opportunity zone. So what is an opportunity zone? Basically, it's kind of an economically depressed area. So the government is trying to go ahead and encourage investment there. Is Rodeo Drive and Park Avenue part of an opportunity zone? Of course not. But guess what? Do you know you could have a property in Rodeo Drive and Park Avenue in an opportunity zone? What are you talking about, Steve? Because if you have a company, you don't have to have 100% in the designated area. So what happens is you say, okay, I have the property in the designated area, but also, in addition, we have the property on Rodeo Drive, we have the property on Fifth Avenue and on Park Avenue, and you put them all together, and then you can make beaucoup on the whole deal and legally avoid the taxes. These are government giveaways.
Interesting. I wanted to ask you also about some of the news we've seen lately about potential changes to taxes around accredited investors and IRAs and self-directed IRAs. Are you keeping an eye on that?
Yes, I am.
I figured you were.
So what happens is, for a long time, the idea with accredited investors was looking at financials. And you could be the Einstein of the financial world, but if you didn't have enough money, say, well, you're not an accredited investor. We're somebody that has no idea of what's an investment, but they have money, is. So finally, and this was relatively recently, finally, after such a long time, they said, well, you know what? We're going to take a look at your knowledge. And by looking at the knowledge, that's a way you can become an incredible investor. And you can do all kinds of stuff. Spouses pooling things and a whole bunch of areas. So what this has done, this has opened up. For example, suppose you want to have a self-directed pension using real estate. And what happens with this? This enables people to make, a certain group of people, to make investments that other people can't, because the government thinks they're protecting you from things, but they're also keeping out a lot of people that could really benefit from this.
So I wanted to ask you one question, and this is not necessarily real estate. What should people know about investing in crypto?
After over 10 years of the IRS's primary focus in life being foreign bank accounts, they finally switched to crypto. And now they have this big program going on called Operation Hidden Treasure. Now that sounds like something in an action adventure movie, Operation Hidden Treasure. But what they're doing with Operation Hidden Treasure is they're looking for people that are not reporting their crypto, and they're also looking for people that are not reporting it properly. So one of the things we did in the office, we actually purchased the same software that the IRS is using, because a lot of times people say, well, the IRS said I made $1 zillion and I actually lost some money here. What's going on? So there's a whole bunch of things you have to watch out for. Also, a lot of criminals chose crypto as their currency of choice, which kind of gave it a bad name. Like anything else, you can use an automobile to run over your next door neighbor, but if enough people did that, we give automobiles a bad name. And that's what happened with crypto. And a lot of people don't understand it, but there's a lot of people that are making boku. It's like mining. In the old days, somebody said they were a miner. You say, oh, wait, coal, gold. Now, miner, oh, crypto. So you take a look at these things. So the first thing is somebody doing something illegal or not? Next, a lot of people are doing things overseas. Well, there's a whole host of special rules when you do things outside the United States. So we have the foreign rules. Then we have things that are more simple. Somebody that just says, well, you know what? I converted my crypto. Oh, well, that's a taxable event. Or somebody else that says, I went and I bought a little something using my crypto. And they don't realize that these are all taxable events. So the bottom line is, first, we want to see, are you using crypto at all? And more people are. And if you are, and there's all the, hard forks, soft forks, all kinds of names make your head spin around again. But the bottom line is, are you in crypto, yes or no? If the answer is yes, we want to take a look at what you're doing and then what you've done in the past. Have you reported everything properly? If you haven't, there's a way before the government goes to the taxpayer that the taxpayer can go to the government and say, hey, you know what, I made a mistake, or I didn't know. And a lot of people really didn't know. And I've come to make things good. All is forgiven. You file what you need to file, which is much better than waiting for them to ferret you out. And another big mistake that a lot of crypto people make, a lot of crypto people think that, oh, well, it's not like a bank. There's no records. There's no way they're going to get caught. Crypto is keeping great records. And the IRS has been successful in a lot of summonses, getting a lot of information. They're just gearing up to go after a whole bunch of people. And a general rule in tax is, if you let's assume you have a little misunderstanding with the government. If the taxpayer goes to the government before the government goes to the taxpayer, you can cut a much better deal. And there's all kinds of deals they'll cut with you. And if you think about it, it makes sense, because if you came forward and the government still slapped you as hard as they would have, then there'd be no incentive. Right now, there's an incentive for people to say, hey, I want to make some corrections. And that's true in crypto and a lot of other areas too.
All right. Well, as we wrap up, one last question for you. Is there any part of the tax code that you think investors are kind of not taking advantage of that when it comes to real estate investing?
Absolutely. When I talk to new clients, things we've talked about before, the cost segregation analysis and real estate professional. Because what I've heard over and over and over again is, well, my accountant told me that I can't use those losses against my other income. And I say, well, wait a minute. Would you or your spouse qualify for a real estate professional? And especially with married people, an awful lot of people, at least one spouse does, especially in situations like this, where you have one spouse, like my example with the brain surgeon married to the house husband. The typical situation is she'd be paying taxes on her building because she made a profit. Most people have never heard about cost seg. So first we wiped out the profit on the building, and then we use it to offset her medical income because we qualify the husband as a real estate professional. When I take a new client, it's like I started speaking another language. To say, what is this? And probably the most common question or statement I'll get from people is, "Oh, is that new?" I say, "No, that's been around for a long time. That's why you left the guy you were with and came to me." And a lot of times the way I pick it up is somebody calls me for something else. They have some other problem. But it's like a medical doctor. If I were a medical doctor and you walked into my office because you scraped your elbow, and I'd say, "Well, okay, I'll treat your elbow, but I couldn't help but noticing there's an arrow in your head. I'd like to address that too." And that's what happens with this arrow in the head.
Excellent. Well, Steve, this was awesome. Thank you so much for your time. Reminder, listeners, you can learn more about Steve, watch his videos, and get in touch with him at moskowitzllp.com. You can always email us at media@millionacres.com. Stay well and stay invested. Thank you.
Thank you for tuning in to the Millionacres Podcast. I hope you liked today's show. If you enjoyed this episode, please consider subscribing through your favorite podcast provider. If you have any questions, please feel free to drop us a line at help@millionacres.com. Stay well and stay invested. People on this program may have an interest in the deals, offerings, or services they discussed at Millionacres, or the Motley Fool may have a formal recommendation for or against. Always consult a certified tax professional before acting on tax advice, and do not buy or sell assets based solely on what you hear.